Okay, hi everyone. This is going to be the second lecture here for chapter 1. Last time, right, we went through, we were kind of talking high level about taxes, what role they play in society, how we define a tax, how we were to calculate what you owe. We said, hey, there's a special way to do it for individuals. The IRS gives you those tables. Ran through an example here, then talked about how we describe taxes, right? We said you have your marginal tax rate versus your average versus your effective. The one thing to be aware of with regard to the marginal tax rate on the homework is when they ask for your current marginal tax rate. When they say that, what they're really asking is, hey, what bucket are you currently in? Are you in the 39% bucket? Are you in the 12% bucket? In distinction to that, they can ask you for your marginal tax rate in relation to changing income, right? Your income goes down, your income goes up. In that way, you would have to use the formula. So if they ask you for current, you just kind of spot where you're at. That's what you get, right? That's what bucket you're in. If they ask for your marginal tax rate, otherwise, in light of changing variables, then you're going to use the equation. So there's the equation. You can look at it. We talked about average versus effective tax rate. We said those are a more accurate way of describing the amount of tax or the percentage that an individual owes. We said the big difference here is the denominator, taxable versus total income. Talked about a flat versus graduated tax rate. And then we said, hey, we have proportional versus progressive versus regressive. Just a bunch of ways to describe taxes. And again, remember, these aren't mutually exclusive. What I mean by that is you can have a graduated tax system that is progressive, and we could be looking at the marginal tax rate in that. So sometimes you may see these items like put together in a question. So there's a visual, and you can look at that. This is really where we're picking things up here. We're saying, hey, who are the taxing authorities? Who imposes these taxes? So you have the government, right? It can be the state government, the federal government, the local government. They have the taxes they impose. And what are the types of taxes they impose? Well, the income tax is the big one, right? That's what we're going to be looking at for individuals and for businesses. That's just one type of tax, though. There's also employment tax, right? If you're self-employed, it's called SE tax. If you're a wage employee, it's called FICA tax. Essentially, that's how they fund Social Security and Medicare, right? That's an employment tax with the tax base being your wages. Similarly, we have sales and use tax. Hey, you go to the dollar store, you buy some stuff, you pay sales tax. Use tax is kind of an oddity. This is if you were to buy something out of state and bring it back into state, they could charge you a use tax. So, for example, maybe you travel to another state and they have a sales tax of 6%, right? You bring it back to your home state that has a sales tax of 10%. You're like, hey, this is great. I paid 6. I would have paid 10 had I bought it here. Your home state is going to get you for that 4% difference, right? So that's a use tax. Further, we have property taxes, right? The tax base here is the value of the property. So, hey, you buy a $100,000 house, you're going to get taxed yearly on that valuation. You have to be careful when you buy a house, though, that you compare the assessed value with what you're paying. A lot of times people pay way more, then they get reassessed, the tax base goes up, they owe way more taxes than they originally thought. Further, estate and gift tax, hey, you die, they're going to get you then, right? But luckily, at least for federal estate tax and gift tax, it really doesn't kick in unless you're like a super millionaire, right? You're given more than $12 million. Then it's really kind of touching and coming in and coming into play. Likewise, state and local taxes, right? So you have to file an income tax return for the feds as well as for the state, right? So they're going to get you in their various ways. Further, we have excise taxes. These are sometimes known as sin taxes. So you'll see it with like cigarettes. The idea with these is these are built into the cost of the product. So if you buy cigarettes, right, there's probably like $5 of taxes built into that. If you buy gas, right, there's a gas tax built into that price per gallon. Here's the visual, right? It's just showing you where the revenues come from. And then, hey, who are the taxpayers that are subject to these taxes? Well, you have individuals, you have businesses, and then not-for-profit organizations. Okay, here's a framework to help you understand taxes, right? So if somebody comes up and they're saying, I'm paying taxes on my job, right? You're going to say, hey, you need to be more specific, right? What are you talking about here? So if we have a guy, right, he's paying federal income tax on his earnings. If we use this framework, it would be the federal individual income tax he was paying. In distinction, if you had a business, right, and they were paying corporate income tax, and it was in New York, right, it would be the New York corporate income tax. So we're taking the tax authority, the taxpayer type, and the type of tax. We can use that to analyze any type of tax. Next here, right, explicit taxes versus implicit taxes. The idea here is explicit taxes are kind of like you see them, they're right there, they're in your face. Implicit taxes are really a tax advantage that arise by virtue of a tax provision. And what they really mean by this, what they're getting at here, is that tax benefit for municipal bonds, right? That is to say, it's not taxable. So you kind of are getting an implicit benefit there because you're not paying tax. Why we care about this, right, is we need to, because we recognize that some types of income are taxable and some types are not, it comes into play when we're making decisions. So, hey, we need to invest in a bond, right? We're comparing two different bonds. How do we do that? So if we look here at example 112, let me pull this over. Right, so they're giving us some information. They're basically saying, hey, you have two bonds, a public company bond and a muni bond. They both have a 10% face value there, market rate. And the only difference between them is that the public company bond, the income from this is going to be subject to a marginal tax rate of 22%, whereas the muni bond is not taxable. Okay, so they're basically saying, hey, which one here should you invest in? Right, so the idea with this, when you run the numbers, when you look at it, right, up front, you may say, well, hey, they're both 10%. I'm going to be, I really don't care about this. Give me either one. But a savvy person, right, because they realize that they're going to pay tax on the public company bond, so like an Apple bond, an Amazon bond, only muni bonds, state and local government, is exempt from tax. Private company bonds and public company bonds, those are subject to tax. So the idea with this is, yeah, we get 10%, but we got to pay tax on that. So our kind of walk away, our after-tax rate of return is 7.8. What that means is, hey, the muni bond is better here. So even though originally they appear the same, after we consider the fact that we pay taxes on the public company bond, the muni bond is going to be the winner, right? That's really what that's saying there. So that's the setup, and here's an example, just another way of showing you, right? You can't really, in light of these tax advantages, these explicit versus implicit taxes, it's not always an apples to apples comparison to compare something that is not taxable versus taxable. In other words, we have to compare them apples to apples, both from an after-tax rate of return, right? So in that framework, right, we're going to have a little equation that we have to do. This guy right here, the after-tax rate of return. So let me pull up a separate sheet here to show you what's going on. Right, so here's an example. Let's say we have a private bond versus a muni bond. As a starting point, right, let's say that this muni bond has a 10% before tax rate of return, right? So just be mechanical with these guys. The first thing, this is the first thing that's always true, is the before tax rate of return for a muni bond is always going to equal the after tax rate of return. They're one and the same. You don't pay tax on it, so it's going to be the same. The before tax is the after tax. Okay? In this case, right, let's say that, and I'm just making these numbers up, that this is 12%, right here. So originally, you may say, right, if you're looking at these, well, the 12% is better. I should invest in that. Here's the deal though, right? This is an oranges to apples comparison. If we want to compare, right, we need to figure this out over here, the after-tax rate of return. So what you would do is, right, in order to figure this out, you're going to solve for, and they'll give you a marginal tax rate, some type of percentage, but you basically plug the information in, right? You would take the before tax rate of return, 12% times 1 minus whatever the marginal tax rate is. That gets you your after tax rate of return. So I don't know, maybe we ran the numbers on this. We solved for this guy right here. It's like the X is right here. And maybe that's 9%, right? And it's all contingent on the marginal tax rate. But what I'm showing you here is, hey, up front, it looked like this guy was better. However, on the back end, this guy is better. So normally when you see these equations, right, what you're doing for is you're solving for the front of the equation in order to compare investments. However, right, the book loves to do these things. Something you might see in the homework is they're going to say to you, what kind of rate would be involved to be indifferent, right? So they would give you this, right? Here's the facts they would say is, hey, we have a 13% rate of return on a muni bond. We have a marginal tax rate of a certain percentage, right? And then they would say, what would we have to charge on this private bond for you to be indifferent? Well, that's a fancy way here of saying these guys have to equal each other. Okay, so here's the starting point. First thing we know is the after-tax rate of return is 13%, right? The before and after are that for the muni. To be indifferent, right, this thing is going to have to equal 13. In other words, right, 13 equals 13. We're indifferent. We don't really care. Give us either one. So the question here then becomes is, in light of, we know these three, we got to solve for that, right? So what you do here in this case is you plug the information in. They give you the percentage. You plug it in there. You get the after-tax rate of return, 13 right there, and you're going to solve for the before-tax rate of return. So, and again, this is the function of the marginal tax rate, whatever would be right here, but maybe it's, 15% or something, right? I don't know. I'm just showing you. The reason I say this is they present it like this right here, and most of the time you're converting it to compare, right? That's 9/10 of the battle. However, in the homework, they may say to you, what percentage do we have to charge for you to be indifferent? So the framework for that is carry over the muni bond. Has to always be the same. This has to equal that because you're indifferent, you don't care. Once you know this, you can back into your before tax rate of return, plugging in the variables on the equation there, just solving for the middle variable. Okay. A few other items here, right? So how do we evaluate a tax system? Well, sufficiency. Is it accomplishing what we're trying to do, right? If we want to raise a school and create a school, we have to raise X amount of funds. Are we doing that? In creating and raising those amount of funds, right, we're going to have to do some forecasting, right? And in this way, there's two types of forecasting. There's static versus dynamic forecasting. So static forecasting is really ignoring any change in user behavior. And what I mean by this is we think things are going to be the same. So here's a story, right? This is an example 113. I'm giving you like the truncated version. Say that we sell 1 million pack of cigarettes, right? And let's say that we're going to raise the price on these, the excise tax, by $2 a pack, right? So we think, hey, we're going to get $2 million from raising the price on this. That's great, right? That's a good strategy, but here's the problem, right? If you raise the price $2 a pack, not everybody's going to smoke as much, right? They don't have the money. So you're not going to sell 1 million packs like you thought. You're probably going to sell less than that. So you're ignoring the change in behavior, namely that people will not buy as many cigarettes. So in distinction, right, you probably are better off doing dynamic forecasting when you're creating tax laws. And this is really taking into account how people are going to react. And there's really two different ways people can react to when you increase or decrease the tax rates. It depends on their facts and circumstances. Specifically, you'll have the income effect versus the substitution effect. The income effect says this: hey, the more taxes, the harder the taxpayers are going to have to work to achieve the same after-tax dollars. So here's the deal, right? You work 40 hours a week and you take home $1,000 each week after taxes. If they increase the tax rate by 10%, in order to take home that $1,000 each week, right, you may now have to work 45 hours a week, right? You're going to have to work harder, work more to get the same take home, that $1,000. That's one situation people would react, right? If you change the tax rates, oh man, now I'm going to have to work more to get that same take home. On the opposite end, right, another way people could react if you increase the tax rate so much is that they actually would stop working or they would work less. This is like, have more leisure activities. By way of example, right, if you start to get like 70 or 80% tax rates on income, right, people are going to say, I don't even want to work anymore, right? You're taking like 80% of what I make. It's not worth my time to work. I'd rather just go relax and enjoy myself. So in doing dynamic forecasting, you have to be aware of those type of reactions. Next thing here, equity, right? So this is a nice way of saying fairness. We need to make sure that when we create a tax system, that it's equitable. And in this way, there's two types of equity: horizontal equity versus vertical equity. Now, horizontal equity says this, right? Taxpayers in the same situation, that is to say, who have the same income, should pay the same amount of tax. So, hey, you make 50 grand and you pay 5 grand in tax. If I make 50 grand, I should pay 5 grand in tax. We will see that given tax preferences and treatments, this isn't always the case. So, for example, maybe you make 50 grand a wage income and you pay 15 grand in taxes. I get 50 grand a capital gain income and I pay $1,000 in taxes. So we will see this, that's not always achieved, horizontal equity. Likewise, with vertical equity, this basically says, hey, people who have more should pay more. So if you make more money, you should pay more taxes, right? You're in a better position to do that. So let me look here, right, the equity question. So you may see some things in the homework, right, where they're giving you some information and they're like, how do we make this horizontally equitable? So here's the deal, right? We said taxpayers in different or taxpayers who make the same amount should pay the same amount. So if we have a guy who makes 100 and he owes 20 in taxes, if we have another guy who makes 100, he should also pay 20 grand in taxes. So that's, if you saw something like that in the homework, you're just kind of identifying and saying, hey, we're making it horizontally equitable. Likewise, vertically equitable, right? We said people are going to, if they earn more, pay more, right? So maybe if you have a guy down here making 20,000 and he pays 1,000 in taxes, if this guy makes 100,000, for it to be considered vertically equitable, and this is from just like a strict definition, it's going to be the $1,000 plus $1, right? Just anything more. It should be way more in theory, right? If you're making 100 grand, you should pay more than $1,000. But to meet the strict definition, you're just going to add $1 to it. Finally, here as kind of like a closing point, again, remember, this is not mutually exclusive, all of these terms. They may ask you things like, hey, how is this system progressive with regard to the average tax rate? Well, we said progressive, right? This is where essentially as you go up the graduated tax rates, the tax rate is going to increase. What you do here is you would find the average tax rate for a taxpayer. If you saw this in the homework, it would be 10%. To apply that to a second taxpayer, you would take their taxable income times 10% and add $1 to it. Technically, right, similar to this situation up here, it would then make it progressive. So that's just kind of, you may see these nuances in the homework. Finally here, right, things when we're looking at a tax system, we're going to want to make sure that we're aware of certainty, convenience, and economy, right? So as I have here, a tax system should instruct taxpayers how to determine their tax liability, when taxes are due and where payments for tax can be made. This one's kind of like comical in the United States because most people are afraid of taxes. They're very uncertain about their taxes. Likewise, another irony here, convenience. The tax system should be designed to fairly collect taxes without imposing undue hardship. Well, most people, it's not very convenient to do your taxes. That's why they pay someone. So again, in theory, it should be convenient, but it's not. And then finally, economy. A tax system should minimize compliance, administration costs of code enforcement. This one's kind of somewhere in the middle for the U.S., right? Like right now, and over the last 10, 20 years, the IRS has been very understaffed, right? And one thing that people always say is on one end of the spectrum, they're like, get rid of the IRS, get rid of the IRS, get a flat tax. That's one way you could kind of save costs here. On the other side of the coin, right, if you're going to fund anything in the government, you should fund the thing that funds everything else. In other words, what I mean by that is put the resources into the IRS because they can then go audit taxpayers and make sure that people are paying their taxes. So it's a debate, right? None of this is perfect. There's plenty of things and interpretations. But with that, I'm going to end the lecture here.